In 2026, the story of Venezuela is no longer political, it's procedural. While politicians argue about democracy and sovereignty, global markets are doing something else. They're opening the books. Venezuela isn't just a country anymore. It's a corporation with the most valuable balance sheet on Earth and one of the worst management records in modern history. 303 billion barrels of proven oil reserves, more than Saudi Arabia, more than anyone. At $70 to $80 per barrel, that's over $20 trillion locked underground. And yet, by 2026, Venezuela is in sovereign default. Oil production has collapsed, infrastructure is decaying, cash flow is broken. This isn't a liberation story. This is a hostile takeover of a distressed asset. Today, we're performing a forensic audit of Venezuela, Inc. We're going to break down how mismanagement destroyed the core business, how debt turned into a weapon, and why bankruptcy in geopolitics doesn't mean collapse. It means transfer of control.
Oil is not a magic fountain. It's an industrial system, and industrial systems decay without constant investment. Every oil field on Earth declines naturally by 10 to 15% per year. To simply maintain production, operators must reinvest roughly 25 to 30% of revenue into capital expenditures, new wells, pressure maintenance, corrosion control, refinery upgrades. Venezuela didn't do that. Under Hugo Chavez and later Nicolas Maduro, the state oil company PDVSA stopped functioning like an energy firm. It became a political cash machine. Oil revenue was diverted into subsidies, social programs, and loyalty payments. Maintenance budgets were cut. Reinvestment collapsed. By the mid-2000s, PDVSA's CAPEX rate fell below 10%, less than half of what's required just to stand still. In 2003, more than 18,000 skilled engineers and managers were purged after a strike and replaced with political loyalists. Experience left. Institutional memory disappeared. The results were predictable. Wells flooded with water. Gas reinjection stopped. Pipelines corroded, refineries deteriorated. By the time international sanctions arrived years later, the system was already failing. Sanctions didn't kill Venezuelan oil, they exposed a corpse. By 2026, analysts estimate that up to 80 to 85% of PDVSA's infrastructure is functionally obsolete. Reviving production will require $150 to $200 billion over the next decade. Venezuela doesn't have that capital, and the longer production stays offline, the more expensive recovery becomes. This wasn't ideological failure, it was corporate negligence on a national scale. When oil prices collapsed in 2014, Venezuela faced a choice. A normal company would restructure. A sovereign state did something else. It borrowed. As revenue dried up, Venezuela issued debt aggressively, sovereign bonds, PDVSA bonds, bilateral loans. Global investors lined up. Why? Because while U.S. treasuries paid 2%, Venezuelan bonds paid 12, 15, even 20%. They became known as hunger bonds. Everyone understood the risk. Everyone understood the humanitarian cost, but in finance, yield is yield. To service this debt, the government slashed imports. Food and medicine imports fell by more than 70% over the decade. The economy contracted by over 2/3, but the interest kept getting paid, until it didn't. In 2017, Venezuela defaulted. From that moment on, this stopped being a political crisis. It became a creditor problem. And creditors don't forget. After the 2017 default, Venezuela didn't disappear from the financial system. It became something far worse, a zombie issuer. By 2026, Venezuela's total external debt, including defaulted sovereign bonds, PDVSA obligations, and international arbitration awards, sits at a staggering $160 billion. None of it is being serviced, none of it is forgiven, and every dollar is legally alive. This is where most people misunderstand sovereign default. They think default means the debt is gone. It isn't. Default freezes the payments, but it activates the lawyers. Dozens of hedge funds, distressed debt specialists, and state-backed creditors quietly accumulated Venezuelan paper at 10 to 20 cents on the dollar. Not because they believed in recovery, but because they understood something else. You don't need Venezuela to pay. You just need assets that can be seized. And Venezuela has assets, just not at home. Here's the brutal reality of international finance. Sovereignty ends where foreign courts begin. Once a country defaults, creditors don't negotiate with presidents, they negotiate with judges. Venezuela lost or abandoned dozens of arbitration cases at the International Center for Settlement of Investment Disputes or other tribunals. Why? Because the state expropriated oil fields, refineries, and energy projects without proper compensation. Each lost case produced a legal judgment. Each judgment became an enforceable financial weapon. Creditors couldn't seize assets inside Venezuela, but they didn't need to. They went hunting abroad. Look at CITGO, Venezuela's crown jewel refining asset in the United States. 3 major refineries, over 750,000 barrels per day of capacity, a national distribution network. CITGO isn't just valuable, it's strategic. For years, it has been sitting in a legal tug-of-war inside U.S. courts. Claims stacked on top of claims, judgments layered like sediment. CITGO is the ultimate hostage asset, the cleanest collateral Venezuela ever owned. And in this courtroom, the U.S. courts hold the gavel. By 2026, multiple rulings have cleared the path for portions of CITGO's equity to be auctioned off to satisfy creditor claims. This is not diplomacy, this is asset liquidation. No tanks, no sanctions, just enforcement. At this point, Venezuela has no leverage. It can't refinance, it can't raise capital, it can't restore production without foreign partners. Any future restructuring will follow one rule: control follows capital. Creditors aren't interested in ideology. They want operational access, production rights, long-term concessions. And this is where geopolitics quietly enters the balance sheet. For Washington, this isn't just about profit, it's about nearshoring energy security. In the geopolitics of 2026, having the world's largest oil reserves in your backyard isn't a luxury, it's a strategic necessity. Especially when global supply chains are fragile, the Middle East is unstable, and Asia's energy appetite keeps growing. Venezuela doesn't need to be invaded, it needs to be restructured. And restructurings don't look dramatic. They happen in boardrooms, courtrooms, and term sheets. By the time oil flows again, the flag may still be Venezuelan, but the operating control won't be. In every sovereign collapse, someone loses control, and someone else quietly acquires it. The winners in Venezuela's case are not presidents or parties. They are patient capital and legal architecture. First, distressed debt funds. These players bought Venezuelan bonds at 10, 15, sometimes 20 cents on the dollar. They didn't expect coupons. They expected court rulings. Their return comes not from recovery, but from enforcement, asset seizures, equity transfers, and structured settlements tied to future production. Second, energy operators with capital and technology. Restarting Venezuelan oil requires tens of billions in upfront investment, advanced heavy crude processing, and decades-long planning horizons. Any new production will be governed by contracts that prioritize operational control over national symbolism. And third, the quiet winner is strategic geography. For Washington, this isn't just about profit, it's about nearshoring energy security. In the geopolitics of 2026, having the world's largest oil reserves within logistical reach isn't a luxury, it's a strategic necessity. For years, Venezuela was presented as proof that the West was losing its grip. China was lending, Russia was drilling, the narrative wrote itself. The reality was colder. China never came to Venezuela as a rescuer, it came as a secured lender. Between 2007 and 2016, Chinese state banks extended more than $60 billion in loans, mostly backed by oil deliveries. Repayment wasn't political, it was mechanical. As production declined, barrels flowed east not for profit, but to service debt. When barrels became scarce, China didn't escalate, it withdrew.
No bailouts, no ideological loyalty, just risk management. By 2026, Beijing largely views Venezuela as a failed upstream experiment, too unstable, too capital-intensive, and too legally exposed. China doesn't manage chaos, it prices it and then exits. Russia's role was different and more revealing. Rosneft didn't act primarily as a lender, it acted as a bridge, providing trading channels, logistical cover, and partial insulation from sanctions, taking minority stakes that looked strategic but remained reversible. But Russia's interest in Venezuela was never about Venezuela itself, it was about leverage against the West. When Russia became sanctioned, stretched, and capital-constrained, Venezuela slid down the priority list. Assets were quietly transferred, exposure was reduced, and risk was capped. By 2026, Russia is not a kingmaker in Venezuela. It is a secondary player, boxed out by U.S. courts and global compliance systems. And this is the structural limit both China and Russia face. They can lend, they can drill, they can trade, but they cannot enforce. They don't control the legal arenas where the endgame is decided. Modern energy isn't governed by flags or rhetoric. It's governed by contracts, courts, and clearing systems. ICSID rulings, U.S. federal courts, Delaware corporate law. CITGO didn't become vulnerable because it was American. It became vulnerable because it was legible to the global legal system. This is where the West holds structural gravity, not through ideology, through enforceability. In the end, enforcement always beats influence. The biggest loser is not the government. Governments rotate, legal judgments don't. The real loser is Venezuela's long-term sovereignty over its own cash flow. A country that once dictated terms now waits for court calendars. An oil state that consumed its future instead of reinvesting it, lost both time and leverage. The oil will return, but the decisions won't. It's tempting to describe Venezuela as a conspiracy, foreign plots, economic warfare, hidden hands. The reality is less dramatic and more damning. No one forced PDVSA to stop reinvesting. No one forced the purges. No one forced the debt binge. The takeover didn't start in courtrooms. It started in spreadsheets. When CAPEX fell below decline rates, the outcome was mathematically inevitable. When debt outran cash flow, control was already lost. What we're seeing in 2026 isn't imperialism, it's financial physics. Venezuela didn't lose its oil. It lost control over the system that turns oil into power. This wasn't a collapse, it was a liquidation in slow motion. And by the time the oil flows again, the paperwork will already be signed. My name is The Hog. Subscribe. We don't do slogans. We do balance sheets.